Welcome to this explainer. If you've ever pulled up a stock chart and just felt like you were staring at a chaotic, completely random mess of red and green lines, you are definitely not alone. To the untrained eye, price action literally just looks like pure noise. But there's actually an incredibly precise language hidden right there in that chaos, and today we're going to teach you exactly how to read it.
Let me ask you a question. Is your stock chart an indicator soup? Covered in so many overlapping lines and colors that you can't even see the actual price? Or, even worse, are you trading against the overall market trend without even realizing it? These are massive pain points for beginners. It's so easy to feel overwhelmed by all that data and end up making really costly mistakes. Well, we're going to clear all of that up right now.
So let's lay the groundwork. At its core, technical analysis is simply the practice of using historical data and current price action to predict future price movements. Now, a really absolutely crucial point here is that we aren't looking into a crystal ball. Technical analysis is all about identifying market psychology and probability, not absolute certainty. It's really just about understanding who is currently in control. Is it the buyers or the sellers? And then stacking the odds in your favor.
Okay, here's our roadmap for today. First, reading the market's language. Second, defining support and resistance. Third, spotting reversals and breakouts. Fourth, navigating with technical indicators. And finally, avoiding common beginner traps. Let's dive in.
Step 1. Reading the market's language. We are going to translate the chaos of candlesticks.
To really understand the market, we have to learn to read the most basic unit of price action. And honestly, it's amazing how much data a single candlestick holds. If you look at the anatomy on the left, that thick colored block is called the body, and that represents exactly where the price opened and closed. Those thin lines sticking out of the top and bottom, those are the wicks, and they show the absolute highest and lowest points the price reached during that specific time period. Green means it's bullish, the price closed higher than it opened. Red means bearish, it closed lower. This brilliantly illustrates the entire story of a trading session. Now look over at the hammer candle on the right. See that incredibly long lower wick? That tells us a really fascinating story. It means sellers drove the price way down, but then buyers stepped in aggressively and overwhelmingly pushed the price back up. It's a classic, textbook sign that a downtrend might be reversing.
Let's move on to another incredibly powerful story, the bullish engulfing pattern. Look at the right side here. Notice how this large green candlestick completely covers, or literally engulfs, the entire body of the previous red one. This isn't just a slight shift in momentum. This is the market screaming that buyers have firmly seized control from the sellers. They pushed the price lower at the open, sure, but then surged way past the previous day's highs by the close. When you see this pattern form at the bottom of a downtrend, you definitely want to pay attention.
Moving right along to Section 2, defining support and resistance. We're mapping the psychological floors and ceilings.
Now that we can read those individual candles, let's zoom out a bit and look at the broader market structure. I want to guide your eyes to the horizontal lines on this chart. That bottom line, that's support. Think of it as the price floor. This is a zone where demand simply overwhelms supply. Buyers believe the asset is a total bargain down here, so they step in, and that prevents the price from dropping any lower. The top line is resistance, the price ceiling. Here, the exact opposite happens. Supply overtakes demand because traders decide the asset is getting too expensive, and they start selling to take their profits. You see, these aren't just random lines on a graph. They're the actual psychological boundaries of the market, where human memory and institutional algorithms tend to cluster their orders.
So the real question is, what happens when the price actually reaches these zones? Well, it usually comes down to two outcomes, a bounce or a breakout. A bounce is exactly what it sounds like. The price rejects the level, often leaving behind one of those long wicks we just learned about, which confirms that the floor or the ceiling is holding strong. A breakout is when the price powerfully pushes past that level. But listen closely, because this is where beginners get trapped. A disciplined trader almost never trades on the first tap alone. We wait for confirmation. In a true confirmed breakout, the price pushes past the level, falls back to retest it, and if that old resistance suddenly acts as your new support, boom, there's your confirmation that the market has accepted this new reality.
Section 3. Spotting reversals and breakouts. Recognizing when the market structure actually changes.
So we're moving up from basic horizontal lines to broader visual patterns. These are the patterns that warn us when a major trend is losing steam. And here is one of the most famous, most reliable patterns in all of trading, the head and shoulders. It's a massive, flashing warning sign that an uptrend is reversing into a downtrend. You can clearly see the large peak right in the middle, that's the head, and it's flanked by two slightly lower peaks, which are the shoulders. Now pay really close attention to that dotted line at the bottom, called the neckline. During the uptrend, the market was happily making higher highs and higher lows, but once the price breaks down below that neckline, that signals a massive structural shift. The buyers are completely exhausted, and the market is now creating lower highs and lower lows. Conversely, we have the inverse head and shoulders, and this shows a downtrend completely running out of gas. You have a deep low in the middle, flanked by two slightly higher lows. The sellers are clearly losing their grip here. When the price breaks that neckline from below, it confirms the buyers have successfully flipped the trend and are back in control. It's just a really beautiful visual representation of market psychology shifting in real time.
Section 4. Navigating with technical indicators. Adding tools without creating indicator soup.
Now, I really need to caution you here. Indicators are fantastic tools, but they must always support your price action analysis. They should never, ever replace it. Your foundation is always the price itself. So, to keep things clean and avoid that indicator soup we talked about, we're going to look at just 3 highly respected essential indicators: the Relative Strength Index, the MACD, and Bollinger Bands. By sticking to just a few trusted tools, we prevent overanalysis paralysis and keep our charts perfectly readable. Let's take a look at them.
First up is the RSI. This is a momentum oscillator that tracks price changes on a simple scale from 0 to 100. When the line crosses above 70, the asset is usually considered overbought, which just means a rally might be exhausted and a pullback is due. When it dips below 30, it's oversold, signaling a bounce could be imminent. But RSI is also amazing for spotting divergences. Think of divergence kind of like a runner sprinting up a steep hill. Their body is still moving forward, but the RSI shows they are totally out of breath. When you see that, a major reversal is usually brewing.
Next, we have the MACD. This brilliant little tool tracks momentum through moving average crossovers. Look closely at where the pink line crosses the black line on this chart. When the shorter-term moving average crosses above the longer-term one, it gives us a bullish signal. When it crosses below, it's a bearish signal. Now, because it uses historical averages, it is what we call a lagging indicator. That means it won't predict the exact top or bottom for you, but it is highly, highly reliable for confirming that a momentum shift is legitimately underway.
Our third indicator is Bollinger Bands, and this one is all about visualizing volatility. You'll notice pretty quickly that about 90% of price action stays within those two outer bands. But I want to point out the specific area marked squeeze on the chart. That is where the bands tightly contract together, showing a period of very low, quiet volatility. Why does this matter? Well, because in the financial markets, a deep contraction like this almost always precedes a massive, explosive price expansion. It is quite literally the calm before the storm. And finally, Section 5, Avoiding Common Beginner Traps. It's time for the reality check of risk management. Because let's be totally honest with each other here. All the fancy tools and candlestick patterns we just learned, they are completely useless if you lack discipline. So let's rapidly fire through the top mistakes beginners make so you don't fall into the same traps. Number 1, loading charts with too many indicators. Seriously, keep it simple and clean. Number 2, trading against the overall trend. The trend is your friend, folks. Trying to catch a falling knife will just get you cut. Number 3, treating support and resistance as exact to-the-penny lines instead of zones. You have to give the market some breathing room. Number 4, overtrading every tiny signal instead of being patient and waiting for those high-quality setups. And number 5, the ultimate account killer, ignoring stop losses and risk management. You absolutely must practice consistently on historical charts and do some paper trading before risking a single dollar of your real capital.
I want to leave you with this sobering thought from our sources. Technical analysis improves probability, not certainty. There is no magic formula. There's no secret indicator that works 100% of the time. Losses are simply a part of trading. This entire discipline is really just a game of identifying market structure to stack the mathematical odds in your favor. So my final provocative question to you is this. Now that you know how to read the language of the markets, are you disciplined enough to accept the inevitable losses and actually manage your risk when the chart proves you wrong? Think about that the next time you open a chart. Thank you so much for joining me for this explainer, and happy charting.